This episode of Analysis in Chains is brought to you by our sponsor, Bankera. Bankera is building a digital bank for the blockchain era, and their token sale is on until the end of February. You can find out more when you visit them at www.bankera.com. And now for our show.
This is the Analysis in Chains with Nathan Williams and Neil Kieran.
Welcome to Analysis in Chains. I'm Nathan Williams, and today joining me is Kain Warwick, founder of Havven. Kain, thank you for joining me today.
Thanks, Nathan. Very excited to be here.
So as I understand it, Havven is a stable coin. It's similar to other solutions that may be out there with a slightly different twist, but the idea is to have a coin that is pegged more or less to a fiat currency. Why don't you tell us just a little bit about the project and how you came to it?
Sure, yeah. So obviously stability is something that is a large problem in the space. Even today, we've got a lot of volatility, in the price of Bitcoin and Ether. And our view is that unless you have a decentralized, stable medium of exchange that systems can use, adoption is going to be very challenging. So one of the examples we use is insurance contracts. If you want an insurance contract that's going to last for quite a while, and you want to put that into a decentralized system, you need something that can be a unit of account within that system in order for the contract to work and function over a long time scale.
Right. So having something stable or more or less stable is probably going to be useful in this case. But how do you actually go about making a stable coin when all of the underpinnings seem to be driven so much by supply and demand?
Yeah, that's a really good point. The market does sort of define price. And what that means is you need to create a mechanism which incentivizes people to create a stable price. So there are a number of different solutions that people are investigating at the moment. In some cases, they use a collateral system. So Tether obviously uses a collateral system where they've got, $1 for every Tether, and it's a one-to-one relationship. We have taken a slightly different approach because we believe that this solution needs to be fully decentralized, and obviously Tether is not decentralized. And the way that we have built our system is to sort of use the paradigm of a closed-loop payment network, so American Express or PayPal. And the way that we've structured the system is to use the fees from the payment network. So we've got a network of stable coins that are all pegged to the US dollar. People are transacting in those stable coins. The fees from those transactions flow through to people who basically stake the system to provide collateral and sort of certainty to the people who are transacting in the network that the network is fully collateralized and that it will be stable.
Okay, so this sounds a lot more technical than something like Tether. So just so I understand, essentially, if I buy your collateral coin, your Havven coin, right,
Yeah.
then I would buy it for, say, Ether, and there would be a certain amount of does the Havven coin vary in price like Ether does?
It does, yeah. So it's a free floating currency like most cryptocurrencies.
Okay, so then I would buy a certain amount of Havven, and then I can use the Havven to stake the system. I'd say, okay, there's a certain amount of collateral that's there, and this allows me to create the stable coin?
Correct, yeah. So basically what you do is you lock the collateral token into a smart contract, and against that value, let's say the stable coin is worth $10 US, you can issue a fraction of that value in stable coins, which are then put into the system for people to transact in.
Okay. And what keeps the value of these stable coins actually pegged to, say, the US dollar?
So effectively, the fact that there is this collateral pool, kind of similar to Tether, obviously, but the collateral is different, right? So the collateral is effectively the future network value or fee value being generated by transactions in the network. So we say we've got this asset, havens, and the asset has a value because people are deriving utility from it and they're paying for it. And against the value of that asset, we're going to issue a stablecoin, which is collateralized by that asset, effectively. Similarly, to people who are using gold or silver, or in some scary cases, oil, to collateralize their stablecoins, we are using a crypto asset to collateralize it.
Okay, so this sounds fascinating. Just again, to wrap my mind around it, because this is about an order of magnitude more complex than something like Tether, where you have $1 is equal to 1 Tether, right? So if I've staked, say, $10 worth of Havven, then I'm allowed to create a fraction of that in stablecoin. And then when we're transacting with that, there are transaction fees. And then I would get a portion of those transaction fees as a reward for staking my Havven?
Correct. That's exactly right.
I see. And so how did, this is rather complex. How did you come to this model?
So I've been working in the payment space for a very long time. I actually dropped out of college or university back in the early 2000s and moved to Seattle to a payment company. And unfortunately, that payment company didn't survive. But I got a lot.
Was it because you dropped out?
No, it wasn't. Peter Thiel wasn't around to hand out $1 million checks, unfortunately, back then. So we had VCs to make it work. But yeah, so I worked in that business for a little while, and definitely learned a lot of lessons around payments. I've also worked in retail, both online and offline. So I have a fair amount of experience in payment networks and how they operate. And I think that people, kind of don't really, they're a little bit opaque, right? So PayPal is pretty opaque. People just kind of think that they're sending US dollars around, but in actual fact, it's just a database that is administered by PayPal, where they've got a ledger of debits and credits, and they control that experience completely. So that's why people complain about their PayPal accounts being frozen, etc. But the model in principle is, if I'm an entity, if I'm a company like PayPal or American Express, and you trust me, a consumer or merchant, to administer that network, you can transact within that network with a fair amount of confidence that the settlement of all those transactions will be administered by those people. And so when I was investigating the problem of volatility, starting from about 18 months ago, I went through a number of different solutions to try and work out, is there a way to resolve this without compromising decentralization? Because clearly you can solve it, as Tether has, by creating a centralized solution. But in my view, at least, I don't think that's scalable to where decentralized systems need to go. So after a number of iterations, one day I was just sitting there and I thought, I wonder if you could use the fee revenue from transactions in the system, like a closed loop payment network, to collateralize the system. And that was kind of the genesis of the idea. Just sitting there thinking about payments one day.
So how long has this been in the making since the early conception? So
I run a company called Blue Shift in Australia, and we are the largest crypto on-ramp in Australia. So we process tens of millions of transactions a month into crypto. So basically, it's like a cash payment gateway that we operate. And so, I've been thinking about crypto and the friction of getting money in and out of cryptocurrencies. We've got in Australia, obviously, we have, it's a small market, so we have a very large spread, and there's a lot of friction to try and get into the market. And so, I've been thinking about these problems for quite a while now, but it was probably in sort of late 2016. I'd been participating in a few sales and a few other things, for about a year at that point. And I just saw it as an opportunity, I guess, to get deeper into the space. It was obviously a huge problem, volatility. And at the time, really, other than Tether, there wasn't a solution out there. So, I saw it as a big problem, and I like to try and do hard things. So, it started researching it, and kind of this is where we ended up.
And And getting your team around you, I guess if you already have a successful company, it does make it easier. But who have been sort of the key people that have helped you to succeed to this point?
Yeah, so obviously in the sort of early days, I was able to access a number of people that were in Blue Shift, including some product managers and stuff to sort of think through the solution and make sure that it wasn't too crazy and that it was actually viable. And then there's a company in Australia that helps to put together blockchain teams called Block8, who I then in sort of mid 2017 approached and said, "Here's my idea. Here's the solution." At that point, I kind of sketched it out, but there was obviously a lot of detail missing. And they put together a team of amazing guys. 5 guys who basically came in, and we were just embedded, working through it, and from sort of July through until November, when we released the original version of the white paper, we just worked really closely together to understand the problem. I also brought in a couple of consultants from Switzerland who run they're part of the Center for Crypto Economics in Switzerland. So brought them in. They're obviously PhD economists, very deep domain expertise. So they helped us to sort of understand the system. So basically just pulled together a team of people, using existing resources that I had access to, and as well as some new people. And yeah, that was kind of it. And then from November, once we had the initial version of the white paper, it's sort of been full steam ahead.
Now, a lot of people have been looking at the ICO space. I mean, ever since last summer. I mean, it was very hot. It seems to have cooled down a little bit over January, but it's now picking back up again. And I think a lot of people are going to be wondering sort of, what does it take to do an ICO? Like how much time should I allot to doing the white paper? How much money do I need to get started? Do you have any sort of insight into that?
I do. It's you. I guess the first thing is you do need to be a little bit crazy. This is, I almost hesitate to call it a startup, but I've been involved in or started 5 different startups over the last sort of 20 years. Some successful, some not so successful. And running a crypto startup or a crypto project, we're not a company. Havven is a protocol token. So it's not being built as a for-profit entity. It's being built as a protocol that's been released open source. And the idea is for it to be integrated into the system. So it's a slightly different structure than you have with a private company. But in terms of getting it off the ground, we raised a small seed round. Again, I've got an existing company, I've got a track record, so it was a little bit easier for me to raise that money from my sort of private network. So raised a seed round in August, September of about $500,000, which we thought would be enough to kind of get us through to February. But by the time we got to December, January, the cost of almost everything in the space had probably gone up 5-fold. So we needed to get a little bit more capital to kind of get through to the sale. But I think at this point to run a successful project from start to finish, which is really at least 18 months, I guess. I say finish as in finish the sale. It's at least 18 months these days. You really can't sort of do it any faster, and that obviously that's crypto time, so that's close to what you would say 3 to 4 year period for a normal startup to get to a level of maturity. But you really do need, I'd say, at least $1 million in funding to be able to do all the things you need to do. We took a slightly different approach to a lot of projects where we were really sort of heads down for the first year almost. And we didn't make much noise. We kind of flew under the radar. And my view was that we were building a project, not trying to run a sale. The sale was about funding the initial collateral of the network, but it wasn't the sort of end result that we were looking for. And so when we, kind of announced the project, really out and started to sort of try and get people engaged, it wasn't until almost January. But we'd done all of the groundwork to make sure that this was a really credible project, that we'd done all the research and work, and we had code available. And so the response was incredible. We went from being totally under the radar to having 100,000 people in our Telegram channel, and a whole bunch of people wanting to get involved in the project, and hedge funds and VCs interested over the course of kind of 2 weeks, because we built that foundation. Yeah.
Well, how did you manage that amount of growth all at once?
Again, if you have startup experience, you kind of you get some scars and you learn certain things. But as I said, crypto is definitely a different beast. There were certainly some mistakes that we made, and one of the challenges is you're trying to make decisions with very little information, quite far ahead of where you are. So you need to make decisions about the structure of the sale, incentives for people, hard caps, et cetera. And so we definitely made some mistakes along the way. But I think the challenge is you just need to be willing to make decisions quickly, and then respond to changing circumstances as you get more information.
And have you found that the crypto community is fairly forgiving of mistakes, or is it really important to get it right the first time?
It's I think the crypto community is very diverse, and so there's certain elements within it that are absolutely unforgiving, and there are certain elements that get it. They understand that you're trying to move very quickly, and that you make mistakes, and that it's okay to make mistakes, and as long as you sort of approach everything in a transparent fashion, and as long as the end goal is to create a viable and healthy ecosystem and project, that people are quite forgiving generally.
Okay. So I want to move back a little bit to talking about stablecoins in general. Like, why do you need a stablecoin? Like, we all know that, crypto is sort of the future and making payments, but, what are some of the use cases beyond just, buying your coffee with it that you might need a collateralized coin?
Yeah, of course. I think that the end goal for almost everything that we're doing is programmable money. Even if you go back to the Bitcoin white paper, the idea, in the title of the Bitcoin white paper is a peer-to-peer electronic cash system. Now, it's, Bitcoin is very successful across most of those components, but as a cash system, the volatility sort of makes it non-viable. So it works very well for other use cases, but as cash, it really doesn't. And this idea that's been around for a very long time, even preceding Bitcoin, there were other solutions, eGold, DigiCash, and B-Money, all the way back, quite a while, to try and create this idea of programmable money. As soon as the internet, gained a level of traction, people understood that if you could put money on the internet and make it electronic, and not be sort of within the existing financial sort of infrastructure, that you could really unlock a lot of functionality. So this idea that you can have a stable medium of exchange that can be transacted between anyone, anywhere. There's almost no use case that doesn't apply to that. Pretty much everything requires money that we do. So this idea of programmable money is really at the center of what a stablecoin is about, and trying to create a viable cryptocurrency that solves that problem.
Now, are you building? You're building Havven on Ether, correct?
Correct. Yeah. Yep.
So it's built on Ethereum. Now, are you concerned at all about the price fluctuations in Ether and in gas affecting the stability of your stablecoin?
Yeah, of course. I kind of sort of touched on when I was doing the initial research into what are the big problems in this space as I was getting back into crypto in 2016, that volatility was a big one, but a far bigger one is obviously scalability. That's the biggest problem in crypto right now. And I guess I have a view that there are some really strong teams that are working on that. I think in principle, scalability is a solvable problem. It's just a question of how long it will take to solve it. So because our system requires transaction volume, we've made a conscious decision to go where we see the transaction volume sort of existing the most. And that's clearly the Ethereum ecosystem.
Now, in the long term, do you imagine yourself building your own Havven blockchain, or do you imagine that it would maintain as part of another protocol that ends up winning the day?
It's a very good question. I think you want to be where the transaction volume is. So clearly there are a number of third gen blockchains or whatever you want to call them that are looking to kind of supplant Bitcoin and Ethereum and some of the older chains, Dash, etc. Our view is that our system will work very well on almost any blockchain, but you do need a kind of inherent transaction volume on those chains for it to be viable. And so if there are other solutions that appear over the next 2, 3, 4, 5 years, we're very open to kind of porting the solution onto basically any chain that supports smart contracts we can move on to, and we can do that fairly simply without impacting the existing system. Obviously, there's some challenges around how you do that and how you split the solution, how you issue tokens, etc. But I think those are all solvable problems. So what we sort of imagine as the scaling onto other chains is basically taking the solution and porting it out to other chains sort of simultaneously.
I suppose as well the advantage of having an Ethereum-based token is that it gives you access to smart contracts faster.
Absolutely.
Now, I want to talk a little bit about the other attempts that people have done at doing a stable coin like Tether, but there's others, are there not?
There are, yeah. So, and there's sort of a proliferation of them over the last 3 to 6 months that have popped up. But probably the oldest one is MakerDAO, which is, again, a decentralized solution that uses collateral. They've got a slightly different approach to us in that they're using existing collateral. So right now they use Ether as collateral, but they're looking at incorporating other blockchain assets as collateral. So I think for us, in principle, we see that as a much more viable and scalable solution than Tether, for example, because at some point, the systemic risk that exists within Tether is sort of non-viable. You can't have a centralized system that has 10, 20, 50, $100 billion worth of currency locked up in order for it to work. So we see that as definitely a solution that works right now, but in the future, scalability is going to be a challenge. Well,
I mean, you must have had an opinion when the big Tether scandal came out a few weeks ago, right?
Yeah. I think our view is essentially this: that it's impossible for anyone to know whether or not Tether is fully collateralized. I personally am of the opinion that I think it is, but I can't know that. And really, that's kind of the problem, is that the structure that they have set up requires it to be very opaque. You can't actually be transparent about what's happening because it will be very likely subject to regulatory issues or seizure or whatever. So they kind of have to operate in this opaque fashion, which just fundamentally limits the trust that people have in it. So even if they're the most trustworthy guys, it could be the Pope that's operating Tether. It still fundamentally has systemic risk. Someone could come in and shut it down, and they wouldn't really be able to do anything to stop that. If the U.S. government decides that they don't want Tether to operate anymore, they have a lot of reach to be able to do that because there is a single point of failure. You just need to find the 4 or 5 people that are operating Tether and put pressure on them, basically.
And I guess that played into your decision to make a decentralized protocol.
We had kind of, obviously long before that came out, and even initially looking at the research, I'm, I guess, a decentralization maximalist. So my view is that whatever can be decentralized should be decentralized to whatever extent it can be. I think that there's obviously a continuum, and we're moving towards more decentralization. So there's certain elements within our system that are more centralized than we would like, but the end goal is to make it as decentralized as possible. The success of Bitcoin is almost completely predicated on its decentralization. The fact that it doesn't have a single point of failure. It doesn't even have, obviously it's got an anonymous founder in Satoshi, but it doesn't even have a single person you can sort of point to and say, let's go get that guy, and we can put pressure on him and shut it down. And I think that's a really big part of the reason why Bitcoin has been so successful. And in some ways, Bitcoin's kind of created a smokescreen, right? So the Ethereum Foundation, obviously, we know who is behind that, we know who's operating it, and yet they're able to kind of operate because you've got this this kind of smokescreen from Bitcoin. So ultimately, we want to see our ability to step back as far as possible from governance and have a decentralized governance. But in the short term, there's some elements that need to be centralized.
Do you think that there's any sort of negative trade-offs that people get by having this decentralization? I mean, that it's sort of like the star in the sky that people are sailing towards is like ultimate decentralization as a way of, making it immune to trust issues and centralized control. But I always wonder, with the more decentralized forums, if it ends up being centralized in another way, either by people who are skilled at getting buy-in from a crowd, or by putting out political pressure on groups, or spreading misinformation. What are your thoughts on that? Do you think that there's definitely a one side or the other sort of thing here, or is it decentralized all the way? Or
it's certainly interesting. I mean, we're still humans, and we're still susceptible to all of our biases and illogical thinking, and so you still need to motivate people. We're building consensus mechanisms that rely on crypto economic incentives, but then to your point, you still need to rally people to your cause and get them excited and all of that sort of stuff. So I think you can't sort of do away with the off-chain governance and off-chain management of any system, which means that ultimately you're always going to have some level of centralization. As you say, whether it's coming from a celebrity founder or something like that, you can't get away from it. And there's always trade-offs. Bitcoin is amazing for what it is, but it's still it's volatile. It's it's slower than it probably could be. And so there's certainly people in the world that would say, well, decentralization is a false economy. Just use PayPal, or just use American Express, or just use fiat currency in a briefcase, right? But I think that the benefits that decentralization brings, censorship resistance being a critical one, it's something that we need. And so it's definitely a worthy cause to be fighting for. But you need to also be, I guess, wary of the trade-offs.
Now, when you're building a stable coin that's stable to a fiat currency, isn't it? I don't know. It seems like you're not completely getting away from centralization in that process, just because you're going to end up linked to the value of whatever the fiat currency is, which is set by a central government. Do you see a conflict there, or do you see it more as sort of like the necessary step to get people into crypto decentralized thinking?
We sort of see it as a bridge. It's a very good point, though. Tying something to a fiat currency, which has fundamental issues, inflation, debasement of currency, centralized control. All of those are very problematic in government-run currencies. So tying it to fiat is definitely a problem, I guess, but it's also, I suppose, a necessary compromise to encourage adoption. People are using the USD globally as a unit of account. It's kind of a global reserve currency. So if you have a cryptocurrency that is able to replace that, there are a whole bunch of benefits that you can get. Our system ultimately does not need to be tied to any fiat currency. So, if you imagine the collateral value is denominated in US dollars, which means that the stablecoin is denominated in US dollars, but it doesn't have to be US dollars. It could be yen, it could be euros, it could be even gold, it could be, ultimately at some point further down the track, some sort of CPI basket of goods. So, there's some challenges in that process, but we really see our solution as a bridge to kind of efficiently move people out of a pure fiat world into a hybrid world of crypto and fiat.
Now, one last question. Specifically, it's about the staking process. If you've got to stake Havven coin in order to be able to mint, what are the stable coins called?
So the US dollar nomans is this kind of generic term, but NUSD is the USD version of that.
Okay, so you if you can stake your havens to make NUSD, and then you for staking the havens get a certain percentage of the transaction fees, then does this create a situation where you have the rich get richer and sort of a de facto oligopoly growing, or do you see that as a problem at all?
We definitely do see it as a problem. It's something that I don't know. I don't want to say that it's an intractable problem in crypto economic systems that require staking, but I think most proof of stake or stake-based systems have this sort of accumulation of wealth issue, which is something that we sort of see as problematic. I personally find it to be problematic. So, there's on one hand utility and creating something that works, but then you really do need to be wary of the trade-offs. Obviously, in some case, centralization trade-offs are it's slow and less efficient. In this case, I guess ideologically, it's less egalitarian if you've got a system where the fees are going to participants who got in early, etc. So we do see that as problematic. I think about it a lot, and I think there are some other things that you can do that can offset that. Potentially different systems that can be built to offset some of those trade-offs. But I suppose in the short term, we see the net benefit. I personally see the net benefit of bringing more people into crypto as a worthwhile trade-off.
And I guess you have the same problems just in fiat currency as well, and where the rich tend to get richer.
Yeah.
But I mean, that's the way with anything, isn't it? I mean, when you're solving these complex problems, you're going to end up trading off at every step of the way. You solve one problem, you create a different one. You solve that problem, you create a new one. But I think they're mistakes probably along the right road.
Yeah, agreed.
So, Kain, you have a token sale coming up, and I believe it starts on the 28th. Is that correct?
That's correct. Yes. Yeah.
All right. Well, it sounds like you are well on the road. Congratulations on getting this far, and best of luck in the token sale. At the time of the recording, I think it's a few days off, but when we air it, it should be the same day of. So best of luck in your token sale, and thank you very much for joining me.
Thanks very much, Nathan. It was a pleasure.
Thank you.